Welcome to ACCA Performance Management Chapter 13, Performance Measurement and Control. In this session, we explore how businesses judge success using both financial and non-financial performance indicators. You'll learn how to calculate and interpret key ratios, understand why short-term profit is not always the best sign of success, and see how models such as the Balanced Scorecard and the Building Block Model help link daily operations to long-term strategy and sustainability. Performance measurement shows how effectively a business meets its objectives. It combines financial and non-financial information. Good control means comparing results, identifying causes, and taking action. These ideas apply in both private and public sectors, where efficiency and accountability matter equally. Financial performance indicators, or FPIs, measure profitability, efficiency, liquidity, and gearing. Profitability shows how much profit is earned from sales or capital. Efficiency measures how productively resources such as inventory and receivables are used. Liquidity checks whether short-term obligations can be met. Gearing assesses long-term risk by comparing debt with equity. Together, these ratios explain how well an organization manages money and risk. Profitability ratios include gross profit margin, operating profit margin, and return on capital employed. Gross profit margin equals gross profit divided by turnover times 100. It shows how much profit remains after direct costs. Operating profit margin equals operating profit divided by turnover times 100. It reflects control over overheads. Return on capital employed equals operating profit divided by capital employed times 100, or operating profit margin times asset turnover. ROAS indicates how efficiently long-term funds generate profit. Rising margins suggest efficiency. Falling ones may mean cost or pricing problems. Efficiency ratios measure how quickly resources turn into cash. Asset turnover equals turnover divided by capital employed. Inventory days equals inventory divided by cost of sales times 365. Receivable days equals receivables divided by sales times 365. Payable days equals payables divided by purchases times 365. High inventory or long receivable days tie up working capital. Very low figures might harm relationships or cause stockouts. Liquidity ratios assess short-term solvency. Current ratio equals current assets divided by current liabilities. Quick ratio equals current assets, inventory, divided by current liabilities. A ratio near 1.5 to 2 is healthy for most industries. Gearing equals debt divided by debt plus equity times 100. Interest cover equals operating profit divided by finance cost. High gearing increases risk but may raise returns. Strong interest cover shows safety. Ratios alone have limits. They focus on short-term results and may encourage manipulation, such as delaying expenses. They ignore non-financial factors like innovation or staff morale and rely on historic data that may not reflect the future. That's why businesses also track non-financial performance indicators, or NFPIs. NFPIs measure the operational drivers of future results. Examples include customer satisfaction, product quality, employee turnover, staff training hours, delivery reliability, and environmental performance. Financial indicators show what happened. NFPIs explain why it happened. Consistent strength in these areas usually predicts future financial success. The Balanced Scorecard by Kaplan and Norton combines both types of indicators across 4 perspectives. The financial perspective asks how value is created for shareholders. The customer perspective focuses on what customers value most. The internal process perspective looks at what the business must excel at operationally. The learning and growth perspective covers innovation, staff skills, and system improvement. Each perspective includes objectives, measures, targets, and actions, ensuring strategy turns into measurable results. It gives a balanced view but can be complex and sometimes subjective. For instance, at a restaurant called Faster Pasta, the financial goal might be higher profit margins. The customer goal, fewer complaints and more repeat visits. Internal goals, faster service and less waste. Learning goals, better training and new recipes. Linking all 4 keeps the business aligned and competitive. The building block model by Fitzgerald and Moon focuses on service organizations. It has 3 parts. First, dimensions. 6 areas: financial performance, competitiveness, quality, flexibility, resource utilization, and innovation. Second, standards. Targets should be achievable, fair, and within managers' control. Third, rewards. Must motivate and link clearly to performance. This model encourages fairness, accountability, and sustained improvement. Performance results must always be interpreted in context. Market conditions, competitor actions, inflation, or exchange rate movements can change outcomes. Stakeholders such as shareholders, employees, lenders, customers, and the community each judge success differently. Effective performance evaluation considers these external influences before drawing conclusions. Sustainability is now central to performance management. Businesses measure energy and water usage, waste and recycling rates, emissions, and staff welfare, including sustainability metrics within the Balanced Scorecard. Under environmental and social perspectives, ensures decisions support long-term profitability and responsibility. Sustainable performance protects both reputation and future cash flows. To summarize, financial indicators reveal profitability, efficiency, liquidity, and risk, the quantitative side of performance. Non-financial indicators show qualitative drivers such as service, innovation, and culture. The Balanced Scorecard links strategy to measurable outcomes, and the building block model ensures fairness and motivation. Good performance management always considers stakeholders, market context, and sustainability. Performance measurement is not just about numbers. It is about insight, learning, and continuous improvement. Thank you for watching this ACCA Wiz session on performance measurement and control. If you found this helpful, please like, comment, and subscribe for more ACCA exam-focused lessons. Keep practicing, stay consistent, and I'll see you in the next chapter.